Okay, let's dive right into this explainer. It's July 23rd, 2026, and if you're watching the charts today, you know exactly what I mean when I say we are witnessing a massive clash in the crypto markets. It's literally panic versus quiet accumulation. The headlines? Flashing red everywhere. But the core of the market? It's standing like a brick wall. So let's separate the signal from all this noise and figure out what on earth is actually propping this market up right now.
Seriously, with the headlines screaming about multi-million-dollar hacks, huge corporate sell-offs, and rising geopolitical tension, we really have to ask, why isn't the market just completely crashing? I mean, think back a few years. This exact 24-hour news cycle would have triggered an absolute double-digit bloodbath. But today, the market is barely blinking. It's totally shrugging off the chaos, and it's leaving a lot of casual retail traders pretty confused while seasoned analysts are absolutely fascinated.
Instead of falling off a cliff, Bitcoin is stubbornly holding this tight, low-volume consolidation range right between $65,000 and $66,000. It's acting as ironclad, immediate short-term support. It's basically drawing a line in the sand, you know? Sure, it's not the explosive moonshot breakout everyone's always hoping for, but honestly, in the context of today's relentless barrage of bad news, this sideways, low-volatility crawl, that's a massive flex of underlying structural strength.
Section 1. The noise. Short-term FUD and fears.
Okay, to really get this paradox, we've got to speed run through the turbulence. It's loud, it's distracting, and honestly, it's perfectly designed to shake out weak hands. We're seeing an absolute gauntlet of exploits right now. First off, DeFi staple SummerFi is throwing in the towel. After 7 years as a respected OG in the space, they're shutting down their UI because of a recent exploit. And then, the AX protocol loses $24 million in a massive bridge hack. Off-Chain Labs even had to step in and clarify it was a third-party issue, not their native infrastructure. But look, the psychological damage was done. Hacks always send a ripple of anxiety through decentralized finance, and today is absolutely no exception.
Adding to that chaos, we're seeing the end of an era. The pioneer derivatives exchange BitMEX is permanently shutting down. This is the platform that practically invented crypto derivatives trading way back in 2014. As of today, July 23rd, they've officially halted all new user registrations, and they're completely shutting down operations by September. Now, sure, their market share has been dwindling for a while, but the total exit of an 11-year-old titan, that's definitely adding to this overarching sense of market instability.
And outside the crypto bubble, the macro weather is looking pretty stormy too. We've got mounting US-Iran geopolitical pressures hitting their 12-day, and that's driving global oil prices up to a 6-week high. You know how this goes. That kind of geopolitical friction severely tanks the broader market's risk appetite. We're seeing it bleed directly into tech equities. Tesla took a painful 5% hit, and Alphabet dropped 3%. Historically, when tech stocks take a beating on risk-off sentiment, they drag crypto right down with them. And yet, Bitcoin remains anchored.
Section 2. The corporate treasury clash. Panic selling versus aggressive accumulation.
So, we are actually witnessing a huge wealth transfer playing out in real time right now. It's a stark contrast. On one side, you have UK-based Satsuma Technology. After a devastating 99% stock crash, their shareholders just voted to hit the panic button. They're liquidating their entire 668 Bitcoin treasury, that's $43.5 million, and completely delisting from the London Stock Exchange. Total surrender. But then, look at the other side. Bitmine Immersion Technologies aggressively leaned right into that volatility, scooping up a staggering $73 million in Ether. That is over 42,000 ETH bought, while everyone else was rushing for the exits.
And this move just brilliantly highlights Bitmain's insane level of conviction. With that single purchase, they've pushed their corporate treasury to hold nearly 5% of the entire global Ethereum supply. I mean, let that sink in for a second. A single public company grabbing 5% of the circulating supply of a Tier 1 asset, completely ignoring all the macro fear and DeFi hacks happening in the background.
Section 3. The signal. Institutional defense and integration.
All right, let's cut through the noise and look at the quiet institutional strength that's really acting as the market's backbone here. This number 6 tells you exactly who is actually buying the dip. Even with the market's fear and greed index sitting at a highly fearful 31, Bitcoin spot ETFs just recorded their 6th consecutive trading day of net inflows. That means for 6 days straight, while headlines were practically screaming disaster, institutional capital looked at that $65,000 price tag and went, "Yep, we'll take that." They're just happily absorbing all the selling pressure from entities like Satsuma. Smart money isn't just ignoring the FUD, they're busy building. We're talking about massive structural plumbing being laid down. Samsung Electronics is adding stablecoin support directly to its mobile wallet. BNY Mellon, literally one of America's oldest banks, is actively preparing for 24/7 tokenized settlements by 2027. Talos is integrating with Kalshi to bring institutional prediction markets on-chain. And Japan, they're officially planning to launch their own Bitcoin ETFs by 2028. This is not just speculative day trading anymore. This is the permanent, structural rewiring of global finance.
Section 4. The Clarity Act Catalyst. Regulatory certainty on the horizon.
Now, the crucial catalyst that could actually trigger our next major breakout isn't some viral tweet, it's the updated Clarity Act, which was just released by Senate Republicans. Years ago, regulation was a dirty word in this space, right? It usually meant massive sell-offs. But in 2026, the narrative has entirely flipped. Regulatory clarity is the ultimate bullish signal, because it provides the legal safety net that trillions of dollars of sidelined capital demand before they jump in. Neutrally breaking down this draft, the bill proposes some serious guardrails. It includes strict ethics bans, stopping federal officials, like the president, VP, and Congress, from profiting off digital asset issuance. The market mechanics here are what really matter, though. The bill explicitly protects non-custodial wallets and mandates strict asset segregation. If approved, this wipes out the fear of retroactive penalization and gives institutions exactly the certainty they crave.
Section 5. Path to 70,000. Transitioning the market.
So how does this actually get us to our next major price target? Well, if this legislative clarity keeps moving forward alongside that relentless ETF accumulation we talked about, it builds a solid, concrete floor. Analysts are mapping out a specific breakout sequence, and right now we're executing step 1, digesting all that geopolitical and platform risk. At the same time step 2 is happening, we're building a base through steady ETF inflows. The real test is step 3. If Bitcoin can slice through that critical resistance zone of $67,000 to $68,000, the structural base is fully set. From there, this low-volume consolidation ends, and the runway is totally clear for step 4, a high-momentum push straight toward the $70,000 psychological milestone.
KuCoin's latest outlook really hit the nail on the head. They noted, the market is transitioning from being narrative-driven to fundamental-driven. And honestly, that is the ultimate takeaway here. The wild, super speculative swings of the past, the ones driven entirely by hype, halving cycles, and panic, they're fading out. Real structural fundamentals are finally taking the wheel. Tokenized treasuries, institutional ETF inflows, clear legal frameworks, the market is maturing right before our eyes.
Which brings us to the ultimate question. With institutions silently buying the dip, weak hands getting flushed out, and comprehensive regulations finally taking shape, the whole landscape has shifted. The noise is insanely loud right now, but the signal, it is undeniable. The only question left is, are you prepared for this new, mature era of digital assets? Keep your eyes on the data, stay focused on those fundamentals, and we will see you on the next Explainer.